Good morning, everyone. I would like to welcome you to today's online presentation, Siegel Rogers Casey's Investment Outlook, Second Quarter 2013 Update. Now I would like to introduce you to our speakers. We have Tim Barron, Senior Vice President and Chief Investment Officer, and John Ross, Senior Vice President and Head of Beta Research. With that, I will turn things over to Tim to begin today's presentation.
Thank you. Thank you all for dialing in. Please note the disclaimers on the first slide here. This is an update following the second quarter where we'll describe our perspective on the U.S. and the global economic environments and how that translates into our views on the absolute and relative attractiveness of various asset classes and sub-asset classes looking out over the next 12 to 18 months. Given that we do a major piece at the beginning of each year, what we're really going to do here is focus on the changes, substantive changes that have occurred from that earlier economic perspective. So for this update, I'm going to cover the U.S. summary. John Ross will cover the rest of the world. Then he'll cover views on traditional asset classes, and then I'll come back and talk about the non-traditional asset classes and then close with some Q&A. So let me begin. So while we see the uncertainty in the U.S. environment continuing, there has been some marginal progress in the U.S. markets, almost as though we've simply adjusted to this new slow growth economy and we're getting to be a little complacent perhaps now, almost as though we're accepting modest growth and we're getting more comfortable with that level of growth. Like most folks, we do see a high likelihood of low rates continuing in the near term, despite the recent jump in rates attributed to comments from the Fed. Those comments by Chairman Bernanke at the June press conference are a pretty good synopsis of where we are today. And I put these up on the screen, and this clear indication of the Fed's intent and where the Fed thinks things are. So the Fed is telling us basically that growth is subdued for the time being. Unemployment is not likely to get to targets until 2015, and we also know that a lot can happen between now and then that could even derail that. Inflation is a distant concern. It's pretty difficult for us not to believe the Fed, given their ability to manage those things. Our own observations are that there's just little real sign that we're getting people back to work. And we also note that the unemployment numbers can be pretty misleading given how many people have simply stopped looking. Interesting piece and some material out by K2 in the last few days on that topic as well that you might want to take a look at. Now, housing markets are feeling a lot better, and price increases are going to make owners feel less threatened, but there's still a lot of complexity in the housing markets. On the one hand, foreclosures are casting a shadow. Mortgage rates are up recently, fairly significantly, but rents are high, encouraging people to substitute ownership for renting and also making affordability indexes attractive again. The National Association of Home Builders Quarter 1 Housing Opportunity Index, which combines interest rates and prices, stood at 73.7 at the end of the first quarter. Now, that was in the 40s pre-recession. So mortgage rates got as low as 3.25% for 30-year fixed and are up now to almost 4.5%. So we would expect that Housing Opportunity Index, while dramatically more attractive than pre-recession, is actually going to be down quite a bit for the second quarter release. There's a big unknown in that sellers, are they going to increase inventory or are they going to stay put? Are they going to hold on to their homes still with dreams of '06 prices dancing in their heads? Housing starts are up substantially since the bottom, but if we look at the numbers in the past, we see that they're still at levels that are lower than at any time since the spring of 1991. That's a long time ago. Now you have college debt, you've got strict lending and credit, you've got parents whose balance sheets are inadequate to fund their retirement, taking care of their parents, and provide down payment capital to their children. So the question we ask is, where will the new real estate buyers come from? For over 30 years, residential housing contributed 18 plus and often more than 19% to GDP. Since the recession, it's gone down to below 16 and touching 15 in many cases. Better than it was in the dark days, certainly, but it's hard to see how that's really going to recover to previous levels. On the bright side, inflation is low, and we're seeing energy independence for the U.S. perhaps on the horizon.